Welcome to our training video on leverage buyouts. This is a topic that is crucial to your understanding of how leverage buyouts work. This video will help you to understand the basics of what a leverage buyout is and the parties involved. A leverage buyout occurs when an investor, typically a financial sponsor, acquires a controlling interest in a company's equity and where a significant percentage of the purchase price is financed through leverage, which is borrowing. The assets of the acquired company are used as collateral for the borrowed capital, sometimes with assets of the acquiring company. Typically, leverage buyouts use a combination of various debt instruments from bank and debt capital markets. The bonds or other papers issued for leverage buyouts are commonly considered not to be investment grade because of the significant risk involved. Typically, leverage buyouts uses a combination of various debt instruments from bank and debt capital markets. Companies of all sizes and industries have been the target of leverage buyout transactions. Although, because of the importance of debt and the ability of the acquired firm to make regular loan payments after the completion of a leverage buyout, some features of potential target firms make for more attractive leverage buyout candidates, including low existing debt loads, a multi-year history of stable and recurring cash flows, hard assets such as property, plant and equipment, inventory, and receivables that may be used as collateral for lower-cost secured debt, the potential for new management to make operational or other improvements to the firm to boost cash flows, and lastly, market conditions and perceptions that depress the valuation or stock price. The bonds or other papers issued for leverage buyouts are commonly considered not to be investment grade because of those significant risks. Leverage buyouts appeal to private equity firms due to the size of acquisitions that can be made with relatively small equity investments. This kind of acquisition brings leverage benefits to an LBO's financial sponsor in two ways. 1. The investor itself only needs to provide a fraction of the capital for the acquisition. And 2. Assuming the economic internal rate of return on the investment, taking into account expected exit proceeds, exceeds the weighted average interest rate on the acquisition debt, returns to the financial sponsor will be significantly enhanced. As transaction sizes grow, the equity component of the purchase price can be provided by multiple financial sponsors co-investing to come up with the needed equity for a purchase. Likewise, multiple lenders may band together in a syndicate to jointly provide the debt required to fund the transaction. Today, larger transactions are dominated by dedicated private equity firms and a limited number of large banks with financial sponsor groups. Since the acquired company will be highly leveraged, i.e. large debt to equity ratio, a suitable LBO target should have an existing strong balance sheet, low initial debt levels, and adequate stable cash flows. To finance LBOs, private equity firms usually issue some combination of syndicated loans and high-yield bonds. Smaller transactions may also be financed with mezzanine debt from insurance companies or specialty lenders. Syndicated loans are typically arranged by investment banks and financed by commercial banks and loan fund managers, such as mutual funds, hedge funds, credit opportunity investors, and structured finance vehicles. The commercial banks typically provide revolving credits that provide issuers with liquidity and cash flow, while fund managers generally provided funded term loans that are used to finance the LBO. These loans tend to be senior secured, floating rate instruments that are pegged to the London Interbank Offered Rate, the LIBOR. They are typically prepayable at the option of the issuer, though in some cases modest prepayment fees apply. High-yield bonds, meanwhile, are also underwritten by investment banks but are financed by a combination of retail and institutional credit investors, including high-yield mutual funds, hedge funds, credit opportunities, and other institutional accounts. High-yield bonds tend to be fixed-rate instruments. Most are unsecured, though in some cases, issuers will sell senior secured notes. The bonds usually have no call periods of 3 to 5 years, and then high prepayment fees thereafter. Issuers, however, will in many cases have a clawback option that allows them to repay some percentage during the no-call period, usually 35% with equity proceeds. The purposes of debt financing for leverage buyouts are twofold. 1. The use of debt increases, leverages the financial return of the private equity sponsor. Under the Modigliani-Miller theorem, the total return of an asset to its owners, all else being equal and within strict restrictive assumptions, is unaffected by the structure of its financing. As the debt in an LBO has a relatively fixed, all but high, cost of capital, any returns in excess of this cost of capital flow through to the equity. Number 2. The tax shield of the acquisition debt, according to the Modigliani-Miller theorem with taxes, increases the value of the firm. This enables a private equity sponsor to pay a higher price than would be otherwise possible. Because income flowing through to equity is taxed, while interest payments to debt are not, the capitalized value of cash flowing to debt is greater than the same cash stream flowing to equity. Leveraged buyouts are sometimes viewed as highly predatory in a hostile takeover situation, since the target company's own financial strength and assets are used as a main source of collateral for the transaction. Whatever the initial transaction motivation is following an LBO, the aim is to meet the increased debt obligations through improved corporate efficiency and/or corporate restructuring. Thank you once again for your time and attention, and this is BusinessTraining.com, where you can earn a master's level qualification to make more money.